Martin North, John Adams, in the interest of people. Hello, John.
Hello, sir.
So we're back on the old stagflation front again then.
Indeed. We've done a few episodes about in terms of stagflation. Stagflation is a serious economic situation because of the impact it has on middle class families, and obviously we are starting to see some of those impacts filter through in terms of unemployment. We've talked about in terms of the rising amount of money supply. In terms of broad money, in previous shows we've talked about your DFA cost of living index, which indicates that about 96% of your survey respondents say that prices are higher relative to 12 months ago. So we are seeing indications of this compressed income situation. At the same time, we've got rising prices, and that's obviously having an impact. And we said that in a previous show, once we hit October, that's going to intensify as we move off the current version of JobKeeper. So where I think we want to extend the conversation today is, I think there's been some very significant statements over the last fortnight, particularly in the last few days by Jerome Powell, the US Federal Reserve Chair. And so it's well worth to basically say that even though we had sort of early statistical evidence and anecdotal evidence that stagflation was on the horizon, we now effectively have confirmation that they are going to not keep to their existing inflation targets. They're going to let inflation run. And obviously we know that unemployment is going up in the short term. So when you have central bankers saying, let inflation go up, at the same time, we know that we're going to have a weak economy with a sluggish recovery. It seems that we have this official confirmation that effectively stagflation is the policy we're going forward with.
Right. Let me just make a couple of points, because people have asked me, where do I stand on the inflation deflation, right? And I keep saying, for me, it's too soon to see which of the two is going to win, right? Because they're pulling in different directions, right? And therefore, I want to explore both sides of the argument. So basically, on IOTP, we're exploring the stagflation. Some of the other people I've spoken to, like Harry Dent, is still on the deflation side of the argument. I'm sort of saying I'm not sure, right? But the other point about Powell's, and we'll get into more detail, of course, he's basically saying he's putting job creation ahead of inflation.
Yes.
Right? So what he's saying is, I'm happy to allow inflation to go a bit higher if I can get full employment sooner. Mm-hmm. Right? So I'm not sure it's trading off jobs versus inflation. What he's saying is that he wants to actually see jobs, and if inflation goes a bit above 2% for a period of time, he's okay, he can live with it, right? Which he didn't effectively want to do previously. So, and then the final point to make is we've got in Australia a 2 to 3% band, right? So we've already got a bit of latitude. They didn't have that in the US, right? They had a target. So there are some differences.
Yes. And look, I mean, in terms of Dent, so the Dent thesis about a deflationary depression, so it all goes back to this premise of the debt has to shrink. Yep. That we have to have defaults, banks have to fail, the system has to collapse. If that happens, I've long said Harry will be correct, but the real policy of when they say let inflation run is they need to print more to keep this bubble intact. And obviously, as the economy gets weaker and the scale of potential defaults could actually increase, they need to print more and more money to keep these banks, these large corporates, particularly in the US, and households, governments from defaulting. They need to print more and more money, particularly as these budget deficits, in terms of them, as these budget deficits get larger. So, in the absence of these announcements that we're going to go through today, and we're going to focus on the US, the UK, and Australia, Harry would be correct. But they're doing everything they can to stop Harry from being correct. And that obviously is, in my view, how we get to this stagflation environment.
Yeah, no, absolutely. And I'm not sure, as I say, where this will land. I think it's also worth making the point that there are a lot of people arguing that they're not really printing. What they're doing is money swapping between Treasury and the Fed, right? First point. And the second is that Harry was right when he said the other day, if they're going to be successful in continuing to print or create more money or whatever, they've got to do it almost logarithmically because of the size of the problem. It's not a linear relationship. It's actually, you have to keep increasing the rate of increase.
Yes.
Right? And we're at the point where that is already astronomical.
Yes.
So therefore, it's going to be very much more difficult to continue that process for a lot longer. Right? I think that's quite an important point to make.
Yes, true. And when we look at the US Federal Reserve balance sheet, we were pre-COVID at about 3.8 trillion, and then it was not exactly double, but it was almost double. It got above 7. So
just over 7. It's just dropped back under 7 now.
Yes. So so that was a lot more printing relative to the GFC. And obviously, so we are seeing a greater increase in the balance sheet relative to GFC. And obviously, as we go forward, there are people out there who anticipate that the balance sheet's going to go well above $10 trillion. So, but we'll obviously have to see how that plays out. But obviously, just to go to so there was a bit of fanfare in the press, but Jerome Powell gave this key. It
was a damn squib in my view, because we knew exactly what he was going to say.
Indeed. So, but Jerome Powell at Jackson Hole. So there's an annual conference among central bankers that go to Jackson Hole. A lot of key policy speeches are made. Jerome Powell basically said that previously there was a target around 2%. And this target came from a series of working papers from 2012 around long-term monetary policy objectives, and that was to have inflation sort of not go above 2%. And now they're saying that officially they are going to allow inflation to go above 2% because they, for a couple of reasons. One is they want to maximize employment. Another reason was that Jerome Powell said that inflation and inflation expectations has been undershooting, and there are consequences to persistently low inflation expectations around interest rates, and therefore he wants to he wants the inflation to go higher. Now, one of the issues I have with this sort of speech was back in 2019, and we've got a link in the notes, so let's actually put this up there. The technical statements of the Federal Open Market Committee, as well as the minutes of the committee, talked about having a symmetrical 2% target. And this was on the premise that we've been undershooting, so we're going to allow to overshoot, and we're going to get to some sort of 2%. So what was announced in the last few days was actually technically announced in 2019. It's kind of like a Scott Morrison press conference. Here's a new announcement, but when you look at the substance, no, you already announced this a few months ago. And that's exactly what has happened. So now, obviously, even though that technically they said this in 2019, the fact that this was given a bit of fanfare and now it's more openly reported. I mean, those who were unaware of the intent of the central bank, I think they're now more aware about, well, no, they're going to actually allow inflation to increase. And so obviously, so what does that mean is not only just from a money printing point of view but it means that we will expect to see exacerbated cost of living pressure moving forward.
Yeah, so it's worth just reflecting on the fact that, as I said, there's nothing new in this because it's already reported spot on. What did happen, though, is got a lot of coverage, and the bond market reacted. In fact, the rates went up, particularly long-term ones, right? And that was because they basically took that as a signal that rates will be much lower for even longer than they thought previously. Yes. Right? Because obviously the way that you actually drive inflation a bit higher is you keep the interest rates very, very low. But they did also say, but not negative. Right, which gives them a very narrow window to play with because the rates are already very, very low, right?
Yes.
So what it basically says, it's going to be long and slow before anything happens with terms of rate rises, which is why the bond rate then moved as it did.
So that's a very good segue to now move on to in terms of the United Kingdom. Yep. So now it's interesting that you say that they didn't say they're not going to go negative. Now, other members in terms of the other governors on the committee in the US have flagged negative interest rates pre-COVID.
Yep.
So obviously, Powell didn't go there.
He's consistently said not.
He said not. Now,
by the way, sorry, just to interrupt. The reason for that is, of course, that the Federal Reserve is owned by the banks, and the banks have great difficulty if rates go negative.
Yes.
Right. So in a way, he would be biting off the hand of those that feed him.
Yes.
If they went negative in the US. Whereas, of course, the ownership structures of the federal is different from the central banks in many other places.
Indeed. So so we had the new governor of the Bank of England. I think his name's Andrew Bailey.
Yep.
He look, I think it was in last week, he flagged again, this was a speech to Jackson Hole. He said that the Bank of England has a lot more capacity for monetary stimulus.
Yep.
So there's an expectation that there'll be more QE in 2020. Official interest rates is 0.1 in the UK, and they're likely to go to 0. But importantly, he did something very similar to what Adrian Orr did in New Zealand, which is to say that negative interest rates is on the table, things are being developed, and we reserve the right to go negative. And obviously, so we've had Adrian Orr saying we're developing our negative interest rate framework. Now the Bank of England is saying that as well. Japan's already gone negative. The ECB's already gone negative. The RBA has testified to federal parliament to say unlikely, but not off the table. And so even though they don't want to openly come out with the truth, we're seeing, bank by bank, this slow crab walk towards where you and I have been sort of flagging things are going to go. Yep. And obviously, the cashless society, availability of cash freedom, it all comes into being because of this slow dance that the central banks are moving towards this negative interest rate environment.
Yeah, and just go back to that IMF paper from some time ago where they said if you want to have the impact of negative rates that you need to control cash, because if you have cash and it's too readily available, basically people will take it out of the system, and that will then negate the effectiveness of negative rates.
Exactly.
And that hasn't gone away, right?
No. That has not gone away.
Yep.
Now, in terms of Australia, now there was about a week and a half ago, I thought, a very important story that was reported both in the Sydney Morning Herald and then in terms of the Australian. And so this was this statement. The RBA Governor Philip Lowe went to the state governments and said, we're not getting enough stimulus out of the state and territory governments, because obviously in order to protect Australia's commercial banks from mortgage defaults, he needs to keep unemployment at a particular level. So if the private sector can't produce those jobs because of COVID and the lockdown, and we have this problem of involuntary unemployment, he needs more jobs being created by various governments. And this is where he's come out and said he wants the states to increase infrastructure spending to the tune of $40 billion. And this is not necessarily... Now, I'm sure he'll argue that we have a infrastructure deficit. We need more infrastructure, but I don't think that's the primary objective of what he's trying to push. He's trying to push people to get into certain jobs so that they don't default in terms of these mortgages. Now, the interesting thing obviously is, well, if the state governments are going to increase their spending by $40 billion over the next couple of years, and if they're going to increase their deficits by a reasonable size, well, how do they fund this? Now, obviously, they didn't say, well, just go and rely on the private sector to buy these bonds. There obviously will be a heavy reliance on the QE program, which is not just buying Commonwealth bonds, but state and territory government bonds in terms of the secondary market. And what this is, Martin, is MMT. So MMT is on the premise that you have an issue of involuntary unemployment. The government ultimately gets to set the level of unemployment. And the whole premise of MMT is that you have a printing press, and basically, you can just print to the extent that you need to fund to be able to fund a deficit, and things should be okay. And obviously, that's kind of what Philip Lowe is sort of saying to the state governments. Even though you don't have your own central banks, we will back you up in terms of your deficits. So just print away. In terms of spend away, we will buy these bonds. We will fund them. And obviously, the big concern I have, and this is a repeated point that I've said to you for 18 months, and again, the mainstream media doesn't answer this obvious question: how do you reverse these policies? And the answer, to my view, is you can't. And that's obviously why I think on the inflation deflation question, we're heading towards the inflation route, because as we go forward, because they don't want to face the demons of this debt bubble, the level of printing, the level of stimulus, the level of bad macroeconomic intervention, it has to increase, it has to intensify if you're going to actually keep this whole house of cards intact.
Right, except that I would argue one other thing which we need to think about, and that is the announcement out of the US is going to have a profound impact in terms of the US dollar and its relationship to the Aussie dollar. It's probably going to push our currency higher because of their rates are going to be lower for longer, right? And that means that rather than getting any benefits of importing inflation into Australia with a lower exchange rate, it's going to go precisely the other way. So effectively, the international relationship could well be to import a deflationary force. And it may well be that whatever we try to do locally with the quasi-MMT or whatever and the state investments and infrastructure, we might not be able to put enough into the system to be able to overcome those deflationary forces which are already coming potentially because of that movement with the US. So that's the other side of the argument. I think it's just worth considering.
So the interesting thing on that question is that so if we have a global stagflation environment, which I think we do, we're going to see commodities in the main rally. So we've seen some commodities like iron ore and lumber start to go up.
Right. But in profit coming back into Australia will be lower because of the exchange rate.
Yeah.
Right. So it actually devalues the funds coming back into Australia in the trade balance.
Sure. But no, the point I wanted to make is that so there's two schools of thought as to what determines the exchange rate.
Yep.
One is the interest rate differential.
Yep.
The other case is our terms of trade.
Yep.
And what I would argue is that similar to what happened in 2010-11 is if you do have commodities right across the board, including gold. And the reason why gold is important in the Australian context is because we're the second largest gold producing country in the world.
Yep.
If you do have a rally in our sort of mineral prices, that will be positive for the Australian dollar versus the US dollar. So the dollar may rally not necessarily because of the interest rate differential between us and the US. It may be the terms of trade. Now, if that were to happen, would that have some deflationary impact in terms of imports?
Definitely would.
Yes. I mean, so obviously it depends on to where the exchange rate goes. Noting that in 2011 it went to $1.10 US.
Yeah.
But even if we have a certain amount of import deflation, because of even if you go back to that period of 2010, 2011, now growth was sluggish and the housing market basically went sort of sideways for a bit. But obviously going forward, if our domestic policies are of a scale which are larger than... So remember, COVID-19 fiscal response is larger than Rudd's 2008-9 response. So if the stimulus is even locally bigger than post-GFC, even if we have an appreciation of the exchange rate, that can still generate domestic inflation.
Yeah. And that's the point, right? This is this balancing thing that I keep coming back to, right? What are those forces that are actually on the downside versus the upside, right? And it depends on, well, how much additional stimulus is put in here, how much is done overseas, what those differential movements are between the exchange rates, right? Because I can play this script two ways, right? I can play this as a deflationary or an inflationary story, right? And I don't think we know enough yet to know which way this is going to actually end up, right? But we need to watch for the signs, right?
Yes. Although when Harry Dent talks about deflation, he's not talking about some minor deflation from imports.
No,
he's talking about the
whole thing going pop.
Whole thing going pop.
Yeah.
And even if we have an appreciating exchange rate, and even if some of our imports coming out of Asia are cheaper in terms of in terms of manufactured goods, that's not necessarily going to see house prices again collapse. I mean, I think house prices will fall.
But it could be it's part of the negative feedback loop, right? That would be my point. And the other point is, less businesses will be able to invest here and will want to invest here. So that's another downward force, right? And we'll probably have more collapses of small businesses. We've talked about that before. So if you put all of those components together, right, there are a lot of things pulling in one direction, which is deflationary, some things pulling in the other direction, which is inflationary, and I don't know where the balance is. So you could well be right. I'm not sure I know.
Yes. The only other thing that I will say is, and we discussed this off camera, is that if the exchange rate becomes too high relative to the US dollar, and if this becomes a concern of the RBA, this is where they'll introduce negative interest rates. I've seen this commentary already in Australia that we need to go negative in order to keep the exchange rate in check.
Correct.
So
Westpac's been arguing that already. Yeah.
There you go. So even if they start to see this in terms of this exchange rate issue, if they think that this is going to be a drag on growth in the Keynesian paradigm, they're already ready. We're sharpening the tools of a whole bunch of other things that they think are necessary to be able to get there. So I don't think this is a linear conversation. I think it's a very dynamic conversation. And so even if the deflation that you think is going to come via the exchange rate occurs, I don't think they're going to sit down and just allow that to take place.
No, and I'm not necessarily. All I'm saying is there are forces up, there are forces down. They're going to tussle with each other, right? The Reserve Bank's going to try and pull whatever levers it has, although I think those levers are probably more broken than they actually perceive them to be at the moment. And there's always that old quote about never bet against the Fed, right?
Yes.
Because their muscle is way bigger than our muscle.
Yes.
Right? It's a really complex and really hard to predict scenario, but we have to explore both scenarios in my view. So the stagflation scenario is definitely a potential outcome with all the things that we talk about and all the consequences. There is also the deflationary one, which I still think is worth thinking about. Look at Japan, look what happened there, So we are in a very fluid, dynamic situation.
Sure. So now when we look at the implications, so now we've looked at sort of the US allowing inflation to run, in terms of the British saying we're going to do more stimulus, we could go negative interest rates. Obviously now the RBA saying spend more money and we'll buy your bonds and effectively MMT domestically in order to minimise involuntary unemployment because of the housing market. So obviously the question is, well, what are the implications? So first implication is, I think we can fairly say is we have in real terms negative interest rates already. So when you look at nominal interest rates versus inflation, they're already negative, and I think they'll become more negative. So now, obviously, we just had this discussion about nominal negative interest rates, but I think the last time we had stagflation back in the 70s, there was negative real interest rates, and that's obviously sort of a telltale sign of a stagflationary environment.
And let's just be clear on definition there. What we're saying is there is an interest rate, but adjusted for what the inflation rate is.
Yes.
Right? So it's effectively the gap between the two. Right?
Indeed.
And in the 70s, it was negative.
Yes.
Right? And the view here is that it perhaps could be negative again.
Yes. Well, so we know that it's already okay. So with the CPI in Australia, so
the official or the real?
So the official is saying we have deflation because they included all of these ridiculous one-off measures, which I had a tussle with in terms of an ABC journalist on Twitter about. But if you actually look at what is the real inflation?
The real number.
The real actual inflation happening in Australia versus the official policy rate, which is 0.25. We already effectively have negative interest rates already.
And by the way, the real base rate, which is the rate between the central bank and the banks, is 0.1 already. So it's actually below the 0.25 cash rate.
Yes. Yeah.
So we're pretty much at zero bounds now.
Yeah. Yep. So obviously, your survey is saying mortgage stress is up, rental stress is up.
Yep.
Cost of living is an issue.
Yep.
My view is that with these policy announcements, that's going to intensify. And one thing I will say is, Martin, is there have been some stories it's been brought to my attention around social consequences, suicides, harm. A lot of this is because of, and in some cases, it's not necessarily because of unemployment or loss of income. It's just because the pressure of cost of living coupled with too much debt has become too much for some people to handle. And obviously, what I would advise is that if you need help, get help as early as you can. Financial counsellors, and we had a discussion about a particular situation off camera. So financial counsellors or whatever the type of help that you need. But obviously, this inflation deflation debate is actually quite important because it fundamentally changes how you allocate capital, how you structure your portfolio. And if you think Harry's right, and you allocate your capital according to what Harry says, and he's wrong, that's going to be a huge financial problem. And obviously, look, that would be the same in terms of the other side as well. So
and that's my problem, John. That's my problem, because there are different strategies that you would adopt: inflation, deflation, right?
Yes.
And the question is, at what point is it too late to have made the decision, right?
Yes.
And it's probably getting quite late in the day, actually, to begin to try and actually say, well, I want to hedge my bets, because I tend to still want to hedge my bet because I don't know which way we're going to go. But at some point, I'll have to make a decision.
Yes.
I haven't made it yet.
Yes. Well, I mean, and so one thing, I've been very transparent with the people who contact me. I've been very clear about.
You know precisely what which way you think it's going to go, and you've taken your steps, and you've made those decisions. So
exactly.
Good on you. Let's hope you're right for your benefit. But I have to say, I'm less convinced than you are that you're right.
Okay, fair enough. I mean, the good thing about economics and finance is there's a scoreboard.
Yeah, exactly. We'll know in a few years' time.
And the scoreboard is net wealth or rate of return. So we'll obviously see how that sort of plays.
And look, the fact of the matter is, I'm still of the view that there's a certain vagueness around this, right? So flexibility and agility is going to be really important, right? But I'm also watching for all these indicators to be able to get a better sense of which way we're going to head, right? And there will be time to react, I personally think. But there you go, I could be wrong, and I could be out of position, and we'll know in a few months' time, probably.
Sure. One thing I just want to close this show on is that we had a bit of an interaction with the ABC journalist Dave Taylor, and he made this comment about broad money, the money supply is not, it's irrelevant because a lot of this created money is going into asset prices. So I just want to make 2 points on this, Martin. First one is that just because money printing is going into real estate, that should not be. I mean, some of these economists, and I remember when I worked for Sinodinos, he had this view as well. It's not a big deal. It's only a big deal when it goes into consumer items. Well, one thing I think you can tell from your data set is that even if you have monetary inflation going into real estate or stocks. Now, stocks, you could say that's how people generate wealth, depending if they've borrowed the money or not. But particularly on real estate, it drives up the amount of debt you have to get into to actually buy one of these things. It drives up mortgage stress. It drives up rental stress. So
it's a Ponzi scheme.
Yes. But no, the thing is, what some of these some of these economists or some of these business writers want to suggest is the impact on the average citizen in terms of their economic welfare is not that significant if it's asset price inflation versus in terms of consumer price inflation. No. And so I would fundamentally disagree with that point. And I think your data would say that even if you have asset price inflation concentrated in real estate, that's a big deal for real people.
Right, and it's a third of the population who are borrowing, right? Including those who aspire to get into the property market. They're hyper-leveraged.
Yes.
And if, in fact, they're going to be given more debt and prices go higher and they have to borrow even more to be able to get that property, then the thing is going to get worse and worse. So it's a third of the population, but it's a very important third.
Well no, but the thing, look, but it's not just a third, because you've got the third who borrowed to buy, but then all of this asset price inflation drives up rents, and then you've got the other third that is actually renting as well.
And that's exactly right. So basically, if it's a third, right? A third borrowing with mortgages, a third owning property, no mortgage, and a third renting.
Yes.
Right? At the moment, rents are going down dramatically, right? In some areas, they're down 9% over the quarter, right?
Yes.
Because there's too much supply, no demand. That's hitting property investors, by the way, as well, right? So again...
Yes, but the key point on that is that even if rent in some quarters are going down, your rental stress numbers are going up because the loss of income is more than in terms of...
Exactly.
So this notion... Now, if you have a property and you've owned it outright and you have no mortgage, maybe for those people, asset price inflation isn't that big of a deal because, if all the inflation is going into real estate and it's not going into actual sorts of things like, consumables like food, etc., they won't be impacted, to the same extent. But you still have 2/3 of the population which are heavily impacted by asset price inflation, and that's significant.
Yep. And that third who has property quite often will have money in the bank, and we're also relying on the interest from deposit, which is now zero.
That's right.
So they're all caught. Right?
Yes.
So wherever you are across that that value chain of owning property with mortgages or renting, all sectors of the population are under the gun, right? That's why my data is so critical to understand, because it isn't just the third that's got mortgages that are being caught by this. It's a much broader question.
Yes. So key point is, if you hear a bank economist or a journalist or whoever says nothing to see here because there's asset price inflation, that's not a really big deal in terms of economic welfare. Complete furphy of an argument.
Yep.
Now, the other thing is that, so obviously we've talked significantly about the manipulation of the CPI. And so even if you look at consumer price inflation or the consumer price index, now we don't have an estimate here in Australia, but there is a couple of organisations in the US that have looked at measuring inflation based on the methodology of the 1990s and the 1980s, and they said, well, compared to what the government is reporting today, how is actually inflation running? Now, we have a graph. Let's put this graph up there. This is from shadowstats.com. So there's an economist called John Williams, which is an American economist. He runs a service, and you can subscribe to his data, but also he publishes some stuff for free. This graph is one of the graphs that he's got it up there, and you've got a attribute that you've taken it from his site, so we're happy to do that. So, but basically, what you can see is that particularly in this post-GFC period, inflation, if you measure it according to the same way as the 1980s, inflation is running at 10%, not in terms of 2%. So you've got the central banker saying inflation is persistently running under this 2% target. Well, one could argue that we potentially have had already stagflation for the last 10 years, and we're seeing the middle class being squeezed, and this is why you've got this huge income wealth gap. But and this has all been done on on the proviso that everything was under control, and inflation was under 2%. Well, now they're saying let inflation rip, and dare I say, we're going to see inflation compared to how we measured previously, that's going to be a lot higher. And obviously in the Australian context, we've said that 1998 was key because that's when they took land out. We have a land bubble, and had land been incorporated in the CPI, the inflation numbers would be much higher. That would have reflected the credit created by the commercial banks and the interest rate policy by the RBA.
Yeah, and that higher inflation, which is the one that people actually experience day to day, which come through my surveys, it's much more aligned to the old way of calculating it than the new way of calculating, which understates, which basically says that the reserve banks around the world are actually shooting at a target that is artificially low.
Yes.
They've consistently failed to meet it, and they're trying to change the rules of the game again. I'm not sure they'll be any more successful.
Yes. And the key point I would want to make is that, in my view, the old age question on this show is, conspiracy versus coincidence. I would dare say that this was a concerted international effort to underreport inflation in order to allow central banks and commercial banks to grow the quantum of debt. And so, it would be legitimate for an Australian journalist to actually delve into this question of the real rate of inflation and why did the Reserve Bank put in submissions in 1998 to the ABS to take land out and to implement other changes? I mean, that would be quality journalism. But again, we've discussed this previously. There are certain questions, there are certain topics which are not to be touched in this country, and this inflation question is something of significance. And I should say that a new senator to the federal parliament, who I've had a discussion with in the last few months, he's absolutely aware of this situation, and he said to me in a phone call a couple of months ago, the CPI is completely BS. It's bogus. So there are people in Parliament who know that this whole notion that we have low inflation, all of this is due to statistical manipulation, and the reality of what their constituents are feeling is much different, which is very reflective of your data.
Yeah, well, I'm afraid that my data is, I think, reflecting accurately what people are saying and feeling. The data is showing more difficulty, and that is unfortunately going to, I think, play out over the next few months. So I fear that's the way it's going to be.
Yeah. So I'm still sticking to the stagflation thesis. I think the announcements we've seen from New Zealand previously, and now we've seen US, UK, Australia, and obviously we're seeing even more calls, ECB, Japan, China, for more stimulus. I mean, that says to me we're headed towards an intensification of stagflation. And for those who wish to believe my point of view, I mean, I have information on my website they can come read, and obviously, there is a way to prepare for the scenario that I think is not coming, but it is currently underway. So people will have to make their judgment as to do they want to go down in terms of the dead path? Do they want to have a mixed a foot in both camps? Do they want to prepare for stagflation? And obviously we'll see how people come out. But I should say that time is of the essence, because announcements are being made, policies are being implemented, and the markets are moving.
Yeah, it's a real now question. John, I appreciate your time today. We'll keep our audience fully up to date as best we can as things develop, and we'll need to watch for the signs.
Absolutely.
Thanks for your time.
Thank you.
Martin North, John Adams, interested people. We'll see you next time.